Efficiently Inefficient: How Smart Money Invests and Market Prices Are Determined, by Lasse Pedersen, describes how various trading strategies used by hedge funds and other professional investors are neither fully efficient nor completely inefficient, but rather a blend of both, creating opportunities for these investors to gain competitive advantages. Pedersen navigates through the financial markets by analyzing different investment styles, the science of active investing, and how market mechanisms balance between predictability and randomness. Here's our pick of the top 10 insights from the book. 1. Professional investors often intentionally trade in a way that is efficiently inefficient, accepting some inefficiencies for higher returns. In the high stakes poker game of professional investing, efficiently inefficient is the smirk you flash when bluffing your way to a pot brimming with chips. These sly market mavens know that the perfectly efficient market is as mythical as a unicorn with a stock portfolio. So they waltz with the inefficiencies, sometimes stepping on toes, but always with an eye on the prize. It's like using a slightly wonky compass because you know everyone else's is downright broken. Sure, you'll wander off path occasionally, but more often than not, you'll find treasure while others are still circling the starting point, scratching their heads with their perfectly polished but utterly useless tools. 2. Despite vast amounts of research and advanced models, many successful investment strategies are more art than science, relying on qualitative judgment. The alchemy of finance. While quant jocks worship at the altar of algorithms, the investment virtuosos play a different tune. Imagine Warren Buffett riffing a jazz solo on his portfolio. That's the kind of artistry we're talking about. Models and charts are all fine and dandy, but when push comes to shove, the market's melody can't always be read from a sheet. It takes a shrewd ear and a steady hand to play the market's unpredictable swings. Sometimes, gut instinct and a well curated collection of business biographies beat out a supercomputer trying to crack the market's next move. Go figure, it seems Wall Street might just have a soul after all, or at least a cleverly disguised, well worn brushstroke that turns data into dollars. 3. Market anomalies such as momentum and value can persist because of the risk limiting behavior of institutional investors, not necessarily because of irrationality. Oh, the elusive quirks of the market, like those hard to catch Pokemon, the anomalies of momentum and value keep investors on their toes. Here's the deal: these oddities stick around like that one party guest who just won't leave. But it isn't because the market's lost its marbles. Nope. It's those big shot institutional investors playing it safer than a game of bingo at a retirement home. They've got their risk seatbelts fastened tight, and their conservative tango means these market quirks get to waltz around a bit longer. So next time you spot an anomaly, tip your hat. It's just institutions doing the risk limbo. And 4. Liquidity provision by smart money can help stabilize markets, but it can also disappear during crises when it is most needed. Well, talk about a fair weather friend. The smart money crowd often acts as the market's stabilizer, offering liquidity like a cool drink on a hot day. But when the market starts burning up with crisis level fever, these financial paramedics can turn into magicians. Poof, and they're gone. It's like during musical chairs. They make sure everyone has a seat when the music's playing. But the moment it stops, they're the first to grab a chair, leaving the rest of us to trip over ourselves. So while they often have the market's back, remember that in times of trouble, they might just take a rain check. 5. Hedge funds and proprietary trading desks employ high frequency trading not just for arbitrage opportunities, but to camouflage their more significant strategic trades. Think of the financial markets as a high stakes game of hide and seek, where hedge funds and prop trading desks are the crafty hiders, and the rest of us are, well, seeking, usually several steps behind. These financial ninjas use high frequency trading, HFT, as their cloak of invisibility, darting in and out of the market in milliseconds. It's not all about quick fire arbitrage, it's the ultimate misdirection tactic. While everyone's eyes are on the flurry of rapid trades, these sly foxes slip their more momentous strategic trades under the radar. It's like a magician flinging a handful of glitter to distract the audience while they pull a live elephant out of a top hat. Surprise! You've been outmaneuvered and you're not even mad, you're impressed. To sum it up, the book, Efficiently Inefficient, reveals how professional investors navigate the paradox of seeking higher returns through embracing certain market inefficiencies and demonstrates that successful investing often blends analytical models with the nuanced art of qualitative judgment. While these strategies can lead to persistent market anomalies and bring stability through liquidity provision, they also expose the vulnerability of markets to liquidity shortages during crises and the complex role of high frequency trading within the investment ecosystem. Hope you enjoy our video.